Good afternoon. I want to thank everybody for logging in and calling in today. As our special webinar, we have a guest on today who's going to talk to us about on-trend real estate investing. So hopefully we're going to have some good information here to share with you in a little bit. Just want to remind everyone who's logging in today live to the call, if you'd like to ask a question during the webinar, either myself or our guest, you can type that question into the chat box on your screen. If you are somebody who's listening to the recorded version of this webinar on our YouTube page or maybe through our Facebook page, you can certainly jot down your questions as you go, and you can reach out to either Dan or myself later on, after you had a chance to view the presentation. So again, if you're listening live today, we're going to encourage some participation. If you have any questions, just type those into the audio box or the chat box, I should say, on your screen. I am your host today. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company for over 11 years now, working in a couple different capacities, but really spending the bulk of my time the last few years overseeing the business development side of our business, both in our Tampa and Atlanta offices. I'm a licensed attorney. I don't do any legal work for Advanta clients, but that is my educational background. So really, again, hope that you get a lot out of today's webinar. I'll enjoy being your host, and I'll look forward to bringing on Dan Summers here in a few minutes from RealtyeVest to talk to you about on-trend real estate investing. Just a quick disclaimer regarding Advanta and what we do and what we don't do. With any seminar or webinar that we have, we always want to make sure that everyone understands that we do not provide any legal, tax, or investment advice, and we certainly don't endorse any particular investments or products. So if you're looking at making an investment with a self-directed IRA account or with a retirement account, it is up to you to decide if, from a legal perspective, from a tax perspective, and certainly from the investment perspective, if that particular asset, particular investment is good for you. We can always give you references to CPAs, attorneys, other financial advisors to help you make those decisions. But again, that's just not something we do at Advanta IRA. Now, who is Advanta? Well, we're a self-directed IRA administrator. We have a combined 20-plus years in the industry over basically holding and administering, again, a self-directed retirement accounts. People wanting to take money in an IRA, an old 401k account, and invest in some type of alternative asset. Now, we hold, between our offices, over $700 million in assets. The cash that we hold is protected through FDIC to protect any cash balances within IRAs. And I really think the benefit of using our service is really having our concierge service. Right? We have an account manager system where everybody who signs up gets assigned to one particular person in our office that you will work with for every transaction you do, regardless of how many transactions you have going on. Really, we found that we've gotten a lot of very positive feedback from people who've used other custodians and not had that same experience, and have one point of contact. We also believe a lot in really educating our clients, either on self-direction or bringing sometimes guests on, like we have today with Dan, to talk about specific areas of their expertise and share that with our clients. So, one thing, again, not all self-directed companies are going to put out as much education, I think, as we do. We do live seminars in our offices. We do webinars like the one you're listening to today. We hold some networking events as well. We really want people to be educated on self-direction and all the, kind of the ancillary related aspects of investing as well. So that's why we partner with good folks to come on and give you some good information and share their knowledge with you. We do have an on-demand YouTube page. You can go on, view our videos anytime you'd like. Certainly reach out to us as well with any questions. For those people who are kind of new maybe to self-direction, you're on the webinar today and not really sure what self-directed IRAs are, just going to quickly cover a few things before we bring on Dan. Really the bulk of the presentation today is going to be Dan Summers talking about the on-demand, or the on-trend, I should say, real estate investing. But for those of you just kind of to get into a quick introduction to self-directed IRAs, a self-directed IRA is one. It simply means that the owner of the IRA has control over what investments the IRA makes. So if it's your account, you're deciding, do I want to purchase real estate, notes, mortgages, crowdfunding projects, private placements, precious metals, etc. You're not being limited by the funds, the different options maybe that your brokerage firm or your bank is offering you. So the IRS rules allow for quite a diverse realm of investments your IRA can hold, but not every custodian is willing to hold those assets. Again, a Charles Schwab or a Fidelity, while great companies, if you want to invest in mutual funds and stocks, they're not going to allow for investments into real estate. It just doesn't fit within their particular business model. So a self-directed IRA basically is giving you that freedom, basically to hold these different types of assets. Again, real estate, private placements, et cetera. Keep that money tax-free or tax-deferred within the IRA, within the retirement account, potentially building your wealth at a faster pace. So if you feel that investing into a particular project or a particular piece of real estate is better for your IRA portfolio, it's going to earn you hopefully higher returns, you're going to feel safer making that investment, a self-directed IRA helps you do that. Now, as far as the funds that can be self-directed, again, if you're kind of new to self-directed IRAs, what monies qualify? Really any type of IRA, whether it's a traditional, a Roth, a simple, a SEP IRA, also any former employer plans. If you worked for a company, you have a 401k, a 403b plan, something like that, those monies also can be used in a self-directed environment, and again, in turn, investing in a lot of the different alternatives that we talk about in our different classes and webinars. So again, if you're looking at an account statement, does this money qualify? If it says IRA somewhere on there, whether it's, again, traditional, Roth, SEP, or simple, that's going to qualify. Any old employer's plan, the old 401k, old 403b plans, those will qualify as well. The only restriction there is somewhat out there is with current 401k plans. Sometimes there is if you're currently involved in a plan, you may not have the ability to move that money within a particular account. As long as you're working for that company, they can place some restrictions on there. So just keep that in mind. Now, as far as the types of assets, we're going to talk about real estate today. What types of real estate could you hold inside your IRA? Really anything that has a deed, anything that has a title to it, your IRA can own it. And when it comes to real estate, whether that's commercial property, whether that's rehabs, flips, it's residential property, condos, duplexes, private placements. I think Dan might touch on some of that in a little bit today. With having your IRA invest into a larger project. Again, real estate forms really a common investment we see here at Advanta. Again, whether it's raw land, duplexes, mobile homes, tax liens, crowdfunding projects, etc. Your IRA can invest in those things. Now, the key thing when you're buying real estate with an IRA account is it does have to be from an investment standpoint. It cannot be a principal residence that you're looking at purchasing. So today we're excited. That's really all I'm going to talk about, self-directed IRAs. If you have additional questions as we go through today, you can certainly ask those of me and Dan as well. At this time, I'm going to introduce our guest speaker. And again, I encourage anyone who's listening, you have questions for either something I talked about or didn't talk about or something Dan's going to address, please ask those in the chat box on your screen. But our guest speaker today is Dan Summers. He's the Chief Executive Officer of RealtyeVest.com. It's a crowdfunding platform. Dan has prior history. He was the CEO of Madison Realty Group and helped take that company public. So I'm going to turn the webinar over to Dan now, let him tell you a little bit more about himself, and then talk about the 2017 real estate trends. Dan, whenever you're ready. Dan, we have a little trouble hearing you. Can you speak up a little bit? Hold on one moment. A little technical difficulties. Hold on 1 second. Oh, sorry, Dan, are you there?
Scott, can you hear me?
Yeah, I'm sorry about that. I apologize again on the phone. A little another technical snafu. But again, Dan Summers, CEO of RealtyeVest. Dan, I'm turning the presentation over to you. So go right ahead.
Buddy, thanks. Sorry for that technical snafu. And again, once again, for the opportunity to co-host a webinar with Advanta and yourself. A lot of the folks that are listening on know me as the CEO of IHT Realty Group. We have just very recently rebranded ourselves as RealtyeVest. We felt we were more in sync with an E-Trade type platform, although we still are a real estate crowdfunding company. We've upgraded the sophistication of our website along with the technology to offer opportunities to investors to invest shoulder to shoulder in real estate and share the risk and mitigate the risk likewise. But in any event, some of the things I wanted to address today was mainly the trends going forward in 2017. I subscribe to the Urban Land Institute and Price Waterhouse Emerging Trend Annual Manual. It's about a 215-page book that discusses in depth the trends that are going to be emerging during any specific year. A couple of the trends this year in their manual popped out at me, and some of the data is really interesting. You'll see in this particular page, you'll see I'm going to be addressing the slower price appreciation, the dynamics of the millennials and the baby boomers, inclusionary zoning from the 1970s, which are now is getting more and more traction, the growing real estate industries like affordable housing, assisted living, over 55 communities, active communities, some technology, and the crowdfunding overview. There's an old saying that goes, today's trends are tomorrow's reality. In fact, the forces that will shape the entirety of 2017's real estate trends are already in motion today and will continue to develop over the coming year. The famous Wayne Gretzky had a very profound statement. It said, skate to where the puck is going, not where it is. And that's how you have to think about your real estate investing. Don't invest in the future based on what's occurred in the past. On-trend investing is really a rules-based approach to answering the age-old question, why should I invest in this deal or should I pass it? A key component in making sound real estate investment decisions is deciphering the misinformation that's out there from accurate statistical data. Conversations at the country club should not be a driver in the process. Investing needs to be viewed as a game of chess, not chance. The investor, yourself, the player, needs to be current, aware of his or her weaknesses and strengths, mindful of the opposition, which is usually the seller, and most decidedly enter the game with a plan. Little in the U.S. macroeconomic data suggests overheating. We're in a pretty good place right now. GDP has settled in at about 2%, and job growth is running about 1.7% or 2.5 million annually. The Fed has been overly cautious about raising the interest rates, although they bumped it a wee little bit recently. But that's due to the volatility of data, the financial markets, and the geopolitical climate and the global climate. Therefore, the veritable punch bowl, if you will, remains. Let's talk about the slowing of the price appreciation. Prices will grow at 3.9% annually, down from the estimated 4.9%. But the punch bowl, as I suggested previously, is still there. But there is a tick down. It won't be a drastic tick down, but perhaps about a point. The consensus shows a slight increase in both new development and housing prices. The national supply of homes for sale are at the lowest in 20 years. Homes are selling at 14% faster, and inventory is down on an average of 11% in the top 100 metros, and it's not expected to improve until next year. According to Redfin.com, 2017 will be the fastest real estate market on record. Homes stayed on the market an average of 52 days in 2016, and it's expected to sell them even faster in 2017. Now, this is the fascinating part of the dynamic, if you will, moving forward, the baby boomers and the millennials. The housing market will be in the middle of these two massive demographic waves, and you want to position yourself wisely and prudently in the middle of this dynamic. Millennials and baby boomers, they'll power demand they will demand most of the power over the next 10 years. Although increasing interest rates prompted Realtor.com to lower its prediction of millennial market share to 33% of the buyer pool, millennials and baby boomers will still comprise the majority of the market. Baby boomers are expected to make up 30% of all the home buyers in 2017. Senior living facilities, as an outgrowth of this dynamic, is going to be one of the strongest in the metro markets to look at and possibly invest into. On top of that, seniors 65 and older will increase from 47.8 million in 2015 to 72 million by 2035. That's a phenomenal statistic to keep in mind when you're putting together your chess pieces. Keep in mind, people today are living longer. The average age is 80 and are more affluent in their senior years. The Villages down here in Florida outside of Ocala, believe it or not, has 112,000 residents. It's the largest senior living community in the United States, and the average household income is $92,000. That's staggering. The average American household income is $47,000, and the average Floridian income is $42,000. So it's a very, very affluent retirement environment here. A lot of them can afford quality care homes costing on average $3,000 to $5,000 a month. They want to maintain their independence. Consequently, they move out of their house, they move down in size, perhaps into a residential living facility or even an assisted living facility, which we'll get into in a moment. The other side of the coin is nearly 50%, actually 47% of the baby boomers, and keep in mind there's 10 to 12,000 baby boomers a day retiring. 47% of them do not have any savings. That's an amazing statistic. So they're going to be living on Social Security. That brings up another opportunity in the affordable housing environment. There's two types of affordable housing. There's the big A and the little A. The big A is a Section 8 type affordable housing, and the little A is the assisted living for the affordable living for the median household income, which is $31,000 to $87,000 annually. Therein lies the opportunity, which we'll discuss in a moment. Inclusionary zoning. It's really an interesting cross-section. In the 1970s, is extraordinarily available in a lot of the cities in the United States. Over 500 of these cities are now in existing inclusionary zoning. It really has to do with the zoning. The counties and the cities are basically mandating that these developers that are going in for proposed market rate developments are now mandating that a certain percentage of that development be set aside for below market rate homes, which might be apartments or lower end housing, which is the mismatch. Let's talk about that for a moment. The mismatch, and this is what we look for when we're looking for trends and opportunities to invest in. The mismatch is the fact that a majority of the real estate developers, single-family home developers in the United States, are building on average $400,000 houses and above. Yet, when you look at the retirees, they're looking to move down in size. They're reducing their income on average. They're living on retirement plans, IRAs, etc. So they're not looking to spend that $400,000 on a house. They're looking for that $150,000 to $250,000 house. There lies an opportunity. Let me flow that opportunity over to the millennials because, again, there is a fierce competition going on in the urban and suburban areas for this type of housing. So the millennials, which is really interesting, they're expected to drive demand for the next 10 years also. They're making up 33% of all home buyers for 2017. What's interesting is that nearly half of the millennial buyers have at least one child. That's up from 45% last year and 43% the year before. And children are the primary driver of home ownership, which is now setting a record, frankly. So in conjunction with the discussion on the retired baby boomers, the millennials are still continuing on with student loans. They have a nominal amount of money for down payments. They have to qualify for loans, and they're still trying to buy the houses and competing against the baby boomers. So therein lies a supply and demand curve, economics 101. So there lies an opportunity to do some serious investing in the housing between $150,000 and $250,000 arena. Real estate industries. Now, the affordable housing, I mentioned that a moment ago. There's a reason that Warren Buffett is the largest manufactured home developer in the United States. It's Clayton Homes. He's a little bit smarter than I am, that's for sure, so I tend to follow his take. So there's obviously a need for lower income housing. Keep in mind the 47% of the retirees have no savings, but they still want to own something. The last bastion, if you will, for home ownership is a manufactured home. Now, there's a lot of developers out there that are buying the existing manufactured home communities, and there are only 50,000 left. There used to be hundreds of thousands of these. They got bought up by developers for, urban sprawl, more developments, more shopping centers, et cetera. So the remaining ones are being picked up by 3 or 4 dozen large developers, and they're being upgraded into developments, security, amenities, landscaping, et cetera. And they're offering these for sale, and this is the interesting dynamic, and for sale to retirees, basically, living on that fixed Social Security income with a very nominal down payment and have the entire note amortized over 5 years. So they'll own that home free and clear in 5 years, and frankly, that debt service payment is less than rent, or rent even on the trailer. So it's a really neat package that a number of these developers have put together and well thought through. The last point down here is 50% of the wage earners make less than $30,000 a year, so it fits right into their wheelhouse as far as affordability. Now, the next thing is suburban homes. It's not a misspelling. Suburban homes is a combination of suburban and urban. They sprawled together. It's walkability. It's where you're finding a lot of millennials and a lot of retirees moving to towns like college towns. We call those suburbans. They live there, they work there, and they shop there. They can walk to their job, they can walk to the bank, they can walk to the restaurant, they can walk to the theater. It's all there. It's walkability. So it's a development, and the millennials basically are driving this. It represents the largest home buyers in third year in a row. They're driving this, and the retirees are on their heels, also moving into these areas.
Hey, Dan,
the next note.
I did have a quick question pop up here. If you want to address it. It just says, what if any guarantee can you give that our money investment funds won't be, I guess they had some bad situations with real estate investing, identity theft. What guarantees that investment money won't be stolen or taken into some misappropriated?
I got a huge echo. I have a huge echo. I can't hear you, Scott.
Oh, I'm sorry.
Try that again.
Dan, just go ahead with the presentation.
Say again? Scott, are you there?
Yeah, Dan, just go ahead with the presentation.
All right, so this next area is 55-plus adult demographics. It talks about the active adult community. They have generated impressive investment returns. These are communities specifically designed for adults 55 and plus. They're household headed by 55-plus populations. They'll comprise a whopping 45% of all households in 2019. From 2005 to 2015, investors achieved a solid 14% return on active adult housing compared to an 8% return on apartments and rental units. Assisted living. This is really interesting. This particular photo, interesting enough, is of a residential house, a residential assisted living facility, which is in Fort Mills, South Carolina. The individual developer, and this is kind of an interesting cross-section of assisted living, where retirees want to maintain their independent living but do not want that institutional feeling to their environment. So entrepreneurial developers are buying single-family homes and redeveloping them, repurposing them into assisted living facilities. So they'll have 6 bedrooms and 6 bathrooms, a common area, kitchen, etc. So Cooking and cleaning is supplied 24/7. Caretakers there. Normally a doctor once or twice a month stops in and sees them. But the key issue here is they can maintain their independent living, write one check a month for normally $3,000 to $5,000, and all of their cares are taken care of, taxes, insurance, etc. No further utilities, rent, etc. So it's an interesting idea, and it's evolving extraordinarily fast in the Southeast market here. Now let's talk a little bit about technology. 2012, President Obama passed the Jobs Act, which allowed for the general solicitation of real estate sales, real estate security sales. And what that meant was if one was interested in investing in real estate, they no longer had to go through their CPA or their attorney. Very simply, can go to a portal which offers real estate investments, a portal that curates investments, underwrites them, puts them on their site, and allows investors to look at opportunities, vet the opportunities, review all the due diligence materials, and invest right there on the platform. And the technology has brought that to fruition over the last, actually since 2012. The industry itself has grown from $400 million to $150 billion. Yes, that's a B, $1 billion forecasted in the next 5 years. So it's a huge industry. Let's talk a little bit about the technology in real estate. The mobile applications are becoming extraordinary. We all have mobile apps on our phones. The technology is just the latest of ever growing a real estate toolbox. Real estate professionals are always on the go, visiting properties and meeting with other clients. Successful new applications that will serve buyers and brokers, landlords, appraisers, developers, and yourselves, the investors, will also have a robust mobile component. Now, research and analytics, there's never been more opportunistic time to do your own research and have access to analytics. Traditionally, research was conducted manually by teams of analysts gathering demographics. You can go to Zillow, you can go to Truly and get all of your own research and information itself. There's open data initiatives in municipalities across the county. You can get on the county recorder's office on your website, on your computer, and pull up all the historical data, et cetera. And combined with the creative needle threading the software developers, such as real estate crowdfunding sites like ourselves. It's changing the entire process of investing. Much more of the data is readily available via monthly SaaS licenses. And then real estate investing. The regulatory changes, as I discussed earlier in 2012, have opened up opportunities for innovation in lending. Our site alone does mostly, probably 75% of our offers are in a first lien or a second lien position. And you'll find that the real estate crowdfunding industry will eventually have the traditional lending institutions and Wall Street looking over their shoulder because it is, in fact, becoming more and more traditional than it was just a couple of years ago. You'll note here that real estate crowdfunding started in 2013, and it went from $400 million to $1 billion to $2.5 billion, and I suggested $150 billion over the next 5 years. So it's another part of our life that's evolving. It's removing the old traditional staunchy lenders, and it's taking it into the next century. So I hope you've had a chance to gain a little bit of insight and a little bit of knowledge as to some of the dynamics for 2017. I would definitely drill down on some of the asset classes I suggested. There's some real opportunity out there for everyone. And once again, if there's any questions, feel free to call us directly. You can get me at dsummers@RealtyeVest.com. Scott, that'll wrap it up for today.
All right. Can you hear me okay now, Dan?
Gotcha.
Okay, good. Yeah, again, if anyone has any questions, please type those into the chat box on the screen. We'll make sure to get those questions answered. Dan, today's presentation was on 2017, some of the trends. What do you see as kind of I don't know how far you go out in the future with looking out, but what kind of trends do you see into 2018, 2019, and even beyond there that you think are maybe evident this year that will continue to be relevant going forward? I know you mentioned the baby boomers, obviously, but any other aspects?
Well, yes, Scott, I do indeed. I feel that The assisted living is definitely here for decades. I feel that the residential assisted living is a component that allows the smaller developer / entrepreneur to bring to fruition. And I would look at those as an investing conduit, because a developer like that is more apt to pay a much higher return and be more conservative with their underwriting. So I like the assisted living arena. I love the affordable housing arena. Once again, there's supply and demand. There's only a certain number, a finite number of mobile home parks, if you will, and there's an infinite amount of need driving that interest. So I will look into those two arenas, frankly.
Yeah, and that question just kind of on the crowdfunding. You showed the graph there with the great increase there, and you mentioned something about the lending aspect as well to it. Are a lot of the crowdfunding deals that are currently out there, maybe all of them are, I'm a little naive in this area, are a lot of them, if you're investing in a crowdfunding, you have an equity position, there is no debt on that particular property, or is there situations where you're investing into some equity, but the ultimate person you're investing with is going to be obtaining some financing going forward?
Yes to all of that. Okay. So this is not institutional opportunities. Okay, this is entrepreneurial opportunities. So as an example, a sponsor will come to us and he'll need he needs $1 million, but the property's worth $3 million and it's free and clear. What we'll do is we'll reach out to our investors and we'll design a first lien and mortgage. And one of the things that we're now doing with our sponsors is that we have a 10 and 10 program. We offer our investors a 10% yield, annualized yield, but 10% of the upside, the profit. So not only are they secured with a first lien position, but they have an opportunity, call it a bonus, to receive participation or part of the profit when the property is either refinanced or resold. So there's debt programs, and then there's equity programs. So, the further up the food chain you go, the less secure you are. Debt is secured with the asset. In the event of a default, certainly there's a clear path to title through the foreclosure. God forbid we have that, but we haven't had one yet, but it is real estate. On the equity side, obviously that offers a much higher return, much higher yield, and it has some security in that you do indeed have the ability to sue the sponsor, which would go through our site. Okay, we are the actual managing member, so the investors invest into our fund and our fund partners with the sponsor. In the event of a default on the first lien, we foreclose on the property. In the event of a default on the equity, we file the lawsuit. So at the end of the day, the further up the food chain you go, the higher the yields. I've seen yields as high as 28%. So there's all kinds of different ways to structure financial packages from the crowdfunding perspective.
Okay, again, if anyone has any other questions, please get them typed in. I guess, Dan, what's one of the biggest thing you want someone to take away from today, just to recap for those of you who, some people kind of jumped in a little bit late, what was the biggest thing you want someone to take away from today's presentation? Sure,
Scott. I think the way I started this out, it's a chess game. Okay, you have to arm yourself with as much knowledge about yourself and the opposition being the seller and the market. So do your homework first, and there's so much information out there via technology. As I said, go to the county recorder's office, go to Zillow, go to Trulia, the MLS, etc. Do your homework first, and the information via technology is there. So consider it a chess game, and when it's your turn to make the move, make sure you've armed yourself with as much knowledge as possible, but don't be afraid to get into the poker game. Remember, you can never win a poker game unless you're at the table. So make your decision, then make your decision to move forward. Do your homework.
And Dan, we had another question come in that says, can we invest through your company, or you're just giving a general presentation? I can answer that. Someone will let Daniel explain a little bit more, but today was kind of more of a general presentation. Dan does have a company, RealtyeVest, that you can contact him about, but I'll let you tell him a little bit more about your company if you'd like to.
Sure, Scott, thank you. And again, this is more from an educational perspective, but my company's website is www.realtyevest.com. We've spent 2 years working on our technology. We're primarily a real estate company and a technology company secondly, but we do indeed underwrite as if we were principals of buying the deals ourselves. So we have sponsors that we have vetted and we've known for a long time that bring us opportunities. We do the due diligence. We host it on our site, and we actually raise money on our site for these sponsors. We'll do anything from fix and flip opportunities to assisted living to affordable housing to multifamily. So depending on your risk aversion, that will dictate what kind of an opportunity you invest in our site. We've got debt and we've got equity. We've got 10 and 10 programs. So take a look. We're always updating our site every week with new opportunities. They tend to close out rather quickly, but we're able to reach out to tens of thousands of investors with the click of a switch. So thank you.
Okay, yeah, I had a couple more pop in. I think these might be for me, but we'll see. The question is, if I move funds from a 401k to Advanta and I'm still working and funding the 401k, so you're still making contributions, do the new contributions stay in the 401k or they go to Advanta? That question is a little bit loaded, and there's a couple different ways to do that. If you are able to do a rollover out of the 401k to an IRA, you can do that and then continue to make your new contributions into the 401k. We do also offer a solo 401k for people who are self-employed. You can simply adopt our 401k plan documents, not only move the funds from where they're currently held to us, but then also going forward make your new contributions to us as well. So there's a couple different options there. So the person that asked that question will reach out to you and make sure we get a good understanding of your situation. Follow up on that, somebody else had asked, do we offer any administrative help for managing a solo 401k? If so, what would be the cost monthly or annual? For our solo 401ks, we have a $300 a year fee to lease our 401k plan document. And we do charge $295 in a year to hold any assets within that plan if you elect to have us do that. As far as the ongoing administrative help, and we make sure part of our cost is making sure the 401k plan stays in compliance, any updates, any changes that are made that you're notified. As far as and doing the management of the assets, we can certainly handle that. That is the $295 a year fee for us to record keep and administer that particular asset. Now, we certainly can refer you to CPAs and other individuals as well for any tax filings that might need to be done for the 401k. There's some exemptions you get as a solo 401k. You don't have to necessarily file anything with the IRS for a little while. But when you do get to that point, we can refer you to a CPA or someone that can help you out with that. That's not something that we do. Let's see, Dan, maybe another question for you. This came up on the real estate opportunities. Is there a minimum amount that you look from the investor to fund a deal? So I guess maybe someone looking to invest in a crowdfunding deal, what is the minimum? Maybe then also address kind of what do you look for someone who's looking for sourcing as their minimum they're putting in?
Sure, it's a great question, Scott. So two ways to answer that. Yes, there is a minimum. It's basically proportionate with the size of the opportunity. I know with our smaller fix and flip deals, we take investments as little as $5,000. And we're about ready to launch a $4 million capital raise for a large assisted living property in Mobile, Alabama, and that'll probably be around a $50,000 minimum. But the one key element one needs to know is that our exception with the SEC is Reg D 506C Title II, which mandates that we only accept investments from accredited investors. It doesn't matter how much we raise, how many deals we raise, or who we raise it from, as long as they are accredited. And let me define accreditation, which you can get accredited right on my site. You need to have made $200,000 last year, this year, and anticipated next year, or a net worth of $1 million with the exception of your primary residence. That's where we fall into our exemption with the SEC. We only need to file a form or Reg D with the SEC, as opposed to the old days when we had to do 40-pound, $25,000 private placement memorandums, which took 6 months of our lives to get pushed through. Now it's done with the blink of an eye. So to answer the question, as little as $5,000 for the smaller fix and flips. They normally 6 months, 9 months at most. And the bigger deals are 24 to 36 months and a minimum of $25,000 to $50,000, once again, depending on the size.
All right, Dan, thanks for answering that. I don't see any other questions coming in. I think at this point maybe we will wrap up the webinar. Dan's contact information was a few slides back. Mine is here on the last one. If you have any additional questions, please reach out to Dan at RealtyeVest.com for questions on that. If you have questions on the self-directed IRA side of things, here is my contact information as well. So I really appreciate everybody logging on today, calling in. Again, if you're watching the recorded version, please reach out to Dan and myself with any questions you have. Dan, again, thank you very much for joining us.
My pleasure, Scott. Once again, thank you again.
Thank you. Right. Everybody have a great day.